Hello and welcome to Earnings Echo. We put together the most important information about Axon Enterprise.
Yeah, and usually when a company's free cash flow misses expectations by a wide margin, investors completely panic. But Axon, they basically just proved why spending heavily today is practically guaranteeing them a monopoly tomorrow. Let's look at the Q1 2026 numbers. Revenue hit $807 million, which is up 34% year over year,
Great.
and adjusted EBITDA came in really strong too at $202 million.
Plus, management didn't just beat estimates. They actually raised full-year revenue growth guidance to a range of 30 to 32%.
Yeah, 30 to 32%.
But we do have to address that sharp Q1 free cash flow miss you just alluded to. I mean, if you are looking at the headline numbers, that cash burn jumps right out at you.
It does, but management immediately countered the concern by introducing new free cash flow guidance of $450 million for the year.
Okay, so that proves the underlying profitability remains intact.
Exactly. The cash flow timing is largely just due to high CapEx investments. Looking at the valuation context, Axon trades at 34 times forward EBITDA.
Right, and if you're analyzing this from the outside, a 34x forward valuation might seem insanely steep to you.
Oh, absolutely.
But the market is pricing in aggressive structural compounding because, well, EBITDA is expected to grow 29% this year. The stock reaction shows investors are totally willing to pay a premium for that kind of visibility.
Yeah, and the primary catalyst for that visibility is software and services, which hit $355 million.
Wow.
That is a 35% year-over-year increase, driven by an explosive 700% year-over-year growth in their AI products, specifically Draft One. And meanwhile, on the hardware side, connected devices grew 33% to $453 million.
Wait, I'm a bit confused here. You just said software and AI are growing explosively.
Right.
Usually, software has incredibly high margins, so I have to critically question this. If software is booming, why did their total gross margin actually drop 150 basis points down to 59.1%? I mean, why is growth currently coming at the expense of gross profitability?
Well, it comes down to the mechanics of how they deploy these systems. Deploying multi-million-dollar software environments requires flying out professional IT teams to physically install the tech and, train the police departments.
Ah, so it costs a lot up front.
Yeah, exactly. Which drags down the gross margin temporarily, but it secures a decade of recurring revenue. Add in global tariffs weighing on the hardware side, and a margin mix shift from the newly acquired D-drone segment.
Right, D-drone.
D-drone saw counter-drone revenue skyrocket over 300%. That hypergrowth temporarily dilutes the blended gross margin.
To give you a quick picture of what is driving that high-margin software demand long-term, Draft One uses AI to automatically transcribe body cam audio into police reports. It saves officers hours of tedious paperwork every single shift.
Yeah, that is the actual utility driving the 700% AI growth.
Right. So they are spending heavily on deployments and taking a temporary margin hit to capture the market. But did management sound worried about this margin compression on the earnings call, or are they seeing enough demand to justify the aggressive spending?
They weren't worried at all. Management maintained a highly confident tone. They emphasized that demand isn't isolated to one product or geography. It is broad-based across U.S., international, and enterprise segments.
Okay.
Crucially, they detailed how they are intentionally building up core inventory of products with long life cycles, like tasers and body cameras.
It's like they are building their own strategic petroleum reserve, but for taser components.
That's a good way to put it.
Because these products have 5 to 15-year shelf lives, locking in hardware now means future supply chain shocks or escalating geopolitical risks simply won't touch them. That is a massive operational shield.
Precisely. And they are pairing that with an innovation shield through the new Axon Vision AI product.
Oh, right, the movement tracking one.
Yeah. By designing the AI to track general movement and activity, like identifying a physical altercation or a medical emergency rather than utilizing facial recognition, Axon is actively threading the needle.
Because they avoid the intense public privacy backlash surrounding mass surveillance.
Exactly, which seamlessly paves the way for their expansion into enterprise and corrections markets.
The long-term echo here is that Axon is successfully transitioning away from being a pure hardware vendor. They are leveraging their devices to build an indispensable, sticky AI and software ecosystem.
Yeah, the stickiness is incredible.
They currently boast a net revenue retention rate of 125%. Meaning, for every dollar a police department spent with them last year, they are spending $1.25 this year because the software is just that integrated into their daily operations.
Which leads you to consider this as Axon continues to aggressively expand into private enterprise sectors without relying on facial recognition. Will their unique, privacy-conscious AI ecosystem make them virtually immune to future macroeconomic downturns?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prep. Catch you again soon.